that was less than 3 months ago. I mean, we're talking about a very heady time in VC that had been going on for many years. However, that same day, the WHO declared a public health emergency of international concern. A sixth case of coronavirus was diagnosed in the US, and it had also spread to about a dozen other countries, including France and Germany. Now we have, as of a couple of minutes ago, over 800,000 cases in the US and 2.5 million worldwide. And of course, we are all confined in our homes for the foreseeable future. So I wanted to, in the next hour, talk about what has changed since we were all together at the end of January. What has changed with what you do, investing, and what you're doing differently now, and how you see that playing out. And I think most people here are pretty familiar with you guys, and the bios are on our sign up page on dot.LA. So I just wanted to have both of you talk a little bit about what your respective firms do, and sort of describe your pitch for your respective firms. And we can start with you, Kara.
Sure. So I'm one of the 8 investment partners at Upfront Ventures. I think we are now the oldest venture fund in Los Angeles. So we've been doing this for almost 25 years. We're currently investing out of our 6th Series A fund. So we primarily invest in seed and Series A companies. So each partner makes 1 to 2 investments per year. We typically take a board seat, we lead, and we're kind of with you for the full journey of your company. Which someday, one of our last pre-COVID exits was in a company we had been on the board of for 18 years. So, you're stuck with us probably when you bring us in. And we invest heavily in Southern California. So about 45% of our investments are in Southern California, but then we also invest nationally and internationally. So a lot of pride in LA and our community in Southern California, but think it's important to invest across sectors and across geographies. But our kind of bread and butter is, a $3 to $4 million investment in early stage companies. Sometimes we used to call that seed. Now we're maybe going back to calling that Series A, across consumer, marketplace, enterprise software. And increasingly, we're doing more and more in ag tech, applied biology, and some other areas that are native to Southern California.
Cool, thanks. Should I jump in, Ben?
I think we lost Ben.
So. I'm back.
All right, perfect. No problem. So I can just jump in, but obviously my brother and I are the founders of M13. So unlike Kara and Upfront that have been around for 25 years, we've been building M13 for the last few years. We're currently investing out of our new $185 million fund. Like Upfront, we primarily focus on seed and Series A. Our focus is really consumer technology. And so we want to understand what consumers are going to be doing 10 years from now. The thesis is that technology is kind of disintermediating and changing consumer behavior faster than ever. And we want to understand what consumers are going to be doing when it comes to how they live, how they eat, how they pay, how they move around, and things like that. And we really focus on kind of what we say is that the need to haves, not the nice to haves. We built a firm kind of, as we say, kind of for entrepreneurs, by entrepreneurs, invested in entrepreneurs. My brother and I had started a company and sold it a few years ago. And what we realized is we believe there was a shift in venture from only kind of picking winners to helping entrepreneurs make winners. As a result of that, we basically built a firm all around kind of being operators and having an operating platform. So the uniqueness of our model is we have something called our Propulsion Platform, which is a tech-enabled platform of frameworks, repeatable behaviors, resources that we think all entrepreneurs need so they don't have to recreate the wheel. And we have 10 partners at the firm. 5 of those focus day-to-day on investing, and 5 of those are vertical expertise partners that help our entrepreneurs every single day wake up better. And so they're focused on brand, product, distribution, acquisition, operations, and talent. And so it's this idea that we can kind of get into the trenches just like Upfront does and work with our entrepreneurs, not only in the boardroom, but in that whiteboarding session. And really the idea is that even the best entrepreneurs realize it's a long journey. And along the journey, you're always going to have strengths. You're always going to have blind spots. You're always going to have a to-do list that's outsized to your resource list. And so there might be a time you need to talk to our partner on data strategy because you're stuck on something, or you're getting ready to launch a product, so you want to talk to our partner on brand and comms. So yeah, and obviously we decided to build the firm in M13 because, like Upfront, who really has continued to set the bar in LA, including obviously the very famous Upfront Summit. We believe there's no better place for the next generation of consumer tech companies than sitting here in LA.
Wonderful. Well, you guys are obviously the perfect people to have here. So I wanted to just jump in and ask you, and Carter, you can take this. What was the first time that you thought that this coronavirus would be a big deal, that it would change our world?
Yeah, if I'm being totally honest, I think I was part of the camp that probably underestimated the impact this would have and how quickly it would develop. We gathered our office together on a Thursday morning, kind of right before, about a week before the shutdown, and said, hey, we've been tracking this closely, and we think we need to shut down the office. So I think we were a little ahead of the curve. Having said that, I don't think any of us envisioned the changes that would happen so immediately with quarantine and kind of lockdown. And obviously, I don't think anyone has ever seen in our lifetimes kind of the drastic consumer behaviors that have changed, in not a matter of months, but in a matter of days and weeks.
What about you, Kara? When did you first see that this would be an issue?
It's interesting. It sort of ties back to the Upfront Summit. About a week before the Upfront Summit, I started getting emails from a couple people who were overseas in Asia saying they weren't traveling anymore. And so that kind of entered my brain. And then one of the days I interviewed Jeff Jordan on stage, and he was elbow bumping and he was no longer shaking. And I went down a rabbit hole of sort of reading about it, I think the Wednesday of the Upfront Summit, which was the last week in January. And we were just talking about this in my family. That was the night that I ordered latex gloves and ramen on Amazon. And my husband thought I was insane, but maybe I'm a survivalist at heart. But that's sort of when it started. And I would say, I think, I've been asked, I was an associate at Battery Ventures in the late 90s. That's when I started in venture. And so people keep sort of asking how to compare it to prior eras, the 2000 bubble bursting and then 9/11, or 0809 financial crisis. And I think there were a lot of us who felt like, okay, we've been through this before in different ways, but I'd be lying if I said I knew what was coming. And I think it's only the last few days where I think I have a feel for how long this can extend, and just the humility we have to understand we have absolutely no idea how this actually plays out, and we're all looking for solid ground to hold on to. But I think just sort of embracing the uncertainty is probably the new way I'm thinking about it.
So Kara, tell me about your day now and how it compares with what you did before, because so much of the VC life is coffee chats, conferences, pitch meetings. Now you are, at home in Santa Monica, probably, in your yoga pants, doing all those things. But how is it different?
I mean, so I am wearing button pants, and I have a flat Stanley of one of my daughters sitting next to my desk. But it's incredibly different. And I think, there's this sort of, how are extroverts responding versus introverts responding. But I've realized just on a personal level that I get energy from people, the classic definition of an extrovert. And so for me personally, I think I've been, doing all the things we're all doing, which is instead of sitting in meetings all day, I'm sitting in Zooms all day. And, what we're doing as VCs, we always have to remind ourselves is not nearly as hard as what you would do as a founder when this is your only kind of, it's like a child, right? And you're worried about the life and death of your child. But as a VC, it's, I think my oldest daughter said to me, Mom, you sit in front of your Zoom all day. I see you less now than I did when you left to go to an office, because to some extent, I compare it to being a litigator in court. I just feel every single day there's sort of a new thing that, we're trying to work through with a venture syndicate, with a founder, with an unexpected change. There are people who are going through sort of stuff that's known, right? If they have companies that distribute, if they're products that are distributed through physical space or retail, or you gather in a space or sporting events. I mean, you can think about a lot of these things. Those are known. Those are the people who've adjusted right away. And a lot of that is sort of constantly looking at, are we making the right decisions on cost? And then the flip side is you have a lot of people who have a hard time figuring out, is it going to impact me and by how much? And to some extent, that's where you have more conversation and harder conversations. But I would say it's, it's a lot of Zooms, it's a lot of conversations, it's a lot more work, I would say, on portfolio, making sure the companies that you've committed to are set up for success. But then there's a lot of business as usual starting to happen, talking to new companies, trying to be thoughtful. I think every venture capitalist is naturally, I always say, we start by having imposter syndrome and immediately move into having a fear of irrelevance. And there's only this small window of time in between where we feel comfortable with who we are. And so there's a lot of like, oh gosh, where should I be investing? I invest a lot in workforce training and education and things like that. And sort of I've picked these fields that now everybody's an expert in. So where should I be spending my time? So I think the good news is you are starting to see a lot of people start thinking about new in the future and taking meetings. It's just everything's moving at a very different pace, much faster for portfolio and much slower for new investments.
And we'll get into new investments in a minute, but would you say that up until now, at least, most of your time has been dealing with your existing companies, sort of making sure they're okay rather than trying to find new ones?
Yeah, I mean, listen, I would say that's accurate, for 100% accurate. I also think it's very individual, right? You have certain partners who are newer and just are on less boards, and they're very much out there. We funded 2 companies where partnership had not met the entrepreneur in person. And so we are doing new investments. For me, it's been heavily portfolio, but then if you like doing this job and you want to do it well, we know you have to invest through cycles. And I've been saying, the Battery Ventures associate in me has been hungry. I'm just dying to meet new companies and founders. And so, I would say it's now shifted to more balance. In the first few weeks, it was almost 180% portfolio. It feels like it's coming back to balance, and we're doing events like this, which I don't think, honestly, I could have even considered or had the mental space to do a few weeks ago. And starting to I'm meeting new founders every day now. So it's coming a bit back into balance, but I think there's still this very big question of how to price things and how to invest in people you haven't met in person, and how quick or slow to go, and how long it's going to take for the market to work through itself. But it's becoming a little bit more normal. It's just, obviously all over Zoom or phone calls.
And just to build on what Kara said, I think, as venture capitalists, all of our jobs is to support our founding teams and our entrepreneurs, right? And so I think everyone kind of immediately retrenched and said, hey, what can we do to help? I think, you used the words, Ben, I think it was making sure the portfolio companies are okay, for lack of a better term. And one thing that we keep encouraging, and we've done a lot of SWOT analysis, a lot of work with our propulsion team, is everyone needs to keep focused on the opportunities, right? And so I think it's naive to think there won't be challenges, there won't be roadblocks, but where there are threats, there are also opportunities. And so I think probably the same goes in Kara's portfolio. There's some companies that are going to have to face some headwinds. They're going to have to think about their P&Ls. They're going to have to think about their business models with so many unknowns. The biggest unknown is time of behavior going back to normalcy and what the new normal is. But on the flip side, there's a ton of opportunity out there, right? We have companies like Capsule and Daily Harvest that are benefiting from the tailwinds and providing kind of essential products, whether it's prescription drugs or food to consumers. And so I've just been encouraging entrepreneurs, both within our portfolio and the broader, is that to do that SWOT analysis and, again, look for those opportunities because they exist, even in days that seem a little cloudier than they were a few months ago.
Yeah, so there was go ahead, Karen.
No, I was going to say one quick thing. I think what Carter said is really important. I think that there's sort of one of the things you just sort of can sit in your emotions and in your worldview. And that's happening to all of us. And I think sort of, that worldview can be, this is going to be awful and my business is destroyed, or that worldview can be, this is going to be amazing and my business is going to be perfect. And I think what we know is that neither of those are true. And you kind of have to, if you're in one, sort of test looking for the other, or vice versa. Otherwise, you're probably going to miss something, because I think things are changing in ways that none of us can expect. And so, I've seen that in, specific portfolio companies where they've gone from one extreme to the other. And if you don't look for pockets of opportunity, you're not going to find them. And if you assume everything's going to be continuously awesome and you're seeing this burst of demand and you don't have a little bit of anxiety for where you're looking for weakness in your business, you're also going to miss that. I just think it's one of the most dynamic times where we can't take anything for granted.
Well, there's been this debate about how much has been business as normal. There was a TechCrunch headline last week that said the idea VCs are still writing checks is bull. And actually your partner, Kara, responded to that. Mark Suster saying, actually, we just wrote a check today. And I know, everyone sort of wants to present an image of relative business as normal. But, how many checks are you writing, and how can it possibly be business as normal during this time? Kara, do you want to take that?
Yeah, I'll take it. I mean, listen, I think it's important to say I have a sample set of one upfront. So, we've been on a consistent pace really for a decade. So typically we make an investment a month at Upfront, roughly. And sometimes it's a little bit less, a little bit more. And we may go through a quarter and do fewer, and then we go through a quarter and we do a lot more. But I think we're roughly still on that pace. And so, Mark mentioned it on Twitter, but we've funded 2 companies that are brand new companies since coming through. We brought another one through last week that we're very seriously looking at. And so I think things are still moving at Upfront. I'd say we're kind of biasing more towards truly bread and butter, $3 to $4 million checks versus the $10 million checks, and having a lot of discipline around how we do it and not rushing. But we're definitely at this point kind of still moving in a very similar fashion. And I think Mark also made this point, but it's an important one to make. If you slowed down and didn't invest, between 07, 08, 09, around that timeframe, you would have missed all of the, the companies that were leveraging the mobile device. And you saw that happen, and you've seen these fund cycles where, you'll take kind of years off or dramatically slow down. I think the big open question here is just how extreme these changes are and how much we know and how we price. But at the earliest stages, the pricing changes maybe a little bit, but not tons. It's just more discipline. And on both sides, I think everyone's going to value longer term partners maybe a bit more. And things like the party round and syndicates that don't behave. I think the bad side of those things you're definitely seeing play out very quickly right now.
And maybe just to build on 2 things there, I think, again, just to make sure we leave this webinar with not doom and gloom, right? We hired 2 people last month, one from Andreessen and one from First Round. We had never even met them in person, right? And they have now both joined the firm, virtually onboarded, and we still never met in person, right? And so, again, we wake up every day and we count our blessings that we get to do a job that we still get to do. That we get to make an impact with so many entrepreneurs that need help now more than ever. And we also think there will be so much great opportunity, great companies, right? Necessity is the mother of all innovation. All these great companies you're seeing today came out of 2008. I think Kara really when it comes to funding and writing checks, I would say 2 things. I think Kara hit the nail on the head, which is it comes down to discipline. So if you think how it works is, people like Upfront and M13, we get money from investors, right? That money is now going to be a little more capital constrained. So funds are either going to take longer to be raised or going to be smaller funds. And so our opportunity cost of capital is going to be higher. And we all want to manage risk in a changing recessionary environment. And therefore, we're going to kind of stick to what we know a little bit more. And so I think the one thing I encourage all entrepreneurs is the bar is going to be raised much higher. And right, Upfront's a world-class institutional investor. We think we're very good institutional investors, albeit new to the game and the new kids on the block in LA. We are going to continue to invest because we know you have to invest through cycles. I think the behaviors you see from people like us are going to be very different than the behaviors you see from smaller funds, what I call kind of tourist investors who were kind of dabbling in the asset class. I think you'll see a stronger pullback from there. But I think anyone who's been through the cycles realizes there will be a lot of great companies that come out of this. And obviously, first and foremost, we all made sure our teams were safe. Secondly, we made sure our entrepreneurs had the support of our firms. And third, it's, hey, let's go back to doing what we're doing, which is invest behind great entrepreneurs and great founding teams.
So Carter, what's it like hiring someone who you've never met, who you have to do over a call like this, which we can see it has its limitations, and also, potentially writing, 7-figure check to someone you've met? And conversely, think about it for the founders who potentially could be adding someone from their board who they've never met. How are you adapting to that? And what do you look for in a video call?
Yeah, I think you just have to think differently, right? And I think one of the key things is whether you're on whichever side of this call you're on is just to push yourself to think differently. So when my brother and I owned our liquor company before this, one of the things we always looked for was good salespeople, right? And so one of the things we would do during the interview process is we'd take them to a restaurant that we knew was really crowded when there weren't any tables, and we'd have them go to the host stand to see if they could maneuver to get us a table. Because we wanted to get them out of a conference room and we wanted to get them into a setting and see how they would react, because people are different, right? When they come into your conference room and they have their resume and they have their prepared answers and you're not getting the right sense. So that's hard to do, right? I can't do that, right? We weren't able to do that with the 2 or 3 people we hired in the last month. So we have to think differently, but we try to think differently within the confines of we have. So we have lunch meetings still, right? But we say, grab a meal and let's eat, because I can still get a sense of a person as they're eating their sandwich in the same way I would do it across the table, right? We do breakouts within M13 with 2 or 3 people, and we sit there and kind of BS just like we're at the water cooler. And so again, necessity is the mother of all innovation. You can take all the same guiding principles that existed 3 months ago on how to hire, how to found people, and you just have to kind of think a little differently. And then I think, right, we'd be kidding ourselves if we didn't think you just have to be a little more comfortable, right? So you might have to, right, like for us, whether it's hiring a person or investing in a company, we probably need to be a little more certain than we did 90 days ago, because there's going to be gaps of the unknown, right? We now have 5 people that are getting ready to move to LA to join M13 that have worked for us that have never stepped foot in our office. That's kind of crazy, but we feel really certain about a lot of other aspects. So we're fine in that respect. So I think it's always the insights are on the nuance. And I do almost everything we did 2 months ago. You just have to slightly differently and be a little more creative.
And Karen, what about you? I mean, because so much of VCs describe their job as getting a feel for founders in a company. And when you're writing those checks now, what are you looking for when you're on a video chat?
Yeah, I mean, it's a very good question. it was interesting. I've again, just started doing a bunch of them again in the last couple of weeks. And I had one last week where I kind of got that feeling of we tend to think about 3 things when we're looking for a founder. You think about product market fit, then you think about founder kind of product market fit, and then we think about upfront founder fit, because there's a lot of great founders who may not be the right kinds of founders for us to work with, and vice versa. And this is a thing that was described to me when I was an associate 20 years ago, and I always thought it sounded kind of like weird and magical, but you do just feel like this kind of person that you like to work with. And you can kind of still get that over a Zoom. I mean, it happened to me last week. And then for me, a lot of it is, I'm spending a lot more time, if I'm interested, thinking about our email exchanges, for example. Like, I like to be very, very conscientious of people's time if I'm not going to dig in. I don't like long maybes. I prefer faster yes or no's. I'll even end meetings sometimes by telling the founder why this isn't the right fit for us, to make it valuable for them or whatever it is. And so, but I have thought a lot more about written interactions. If I am interested, like, how does their brain work? How does my brain work? And then, there's certain things, I call it the cocktail party test, which I guess I need to call it the cocktail Zoom test or something, but it's, am I driving people crazy who are not in my industry or who are not investors talking about this thing? Am I thinking about it? Am I wanting to use it? Am I wanting to tell people about it? And, there's this enterprise software company I spoke to last week where that's happening. And I'm getting a lot of just like emotional gratification out of the email. I got sort of the sense of connection on the Zoom. I'm making my husband crazy talking about it. So we'll call it the crazy husband test, I guess. Crazy test. But I don't, it's not a totally answered question for me because I haven't made an investment yet in somebody I've entirely met over Zoom. I'll tell you though, I'm thinking about my time really differently. I'd say now versus before. I sort of feel like if I can't figure out how to be a better version of myself now when I should have the time and I'm not commuting, I don't know, there's something wrong with me, but I'm not sure I've gotten there. But one of the things I've been thinking about is just spending more time with people in LA. So if I haven't met them yet, but there's a much higher chance that I will be able to meet them or take a socially distant walk when, that starts to happen, because I don't think it's going to be all or nothing. I think it's going to be a gradual re-engagement, or people I have met in the past in LA who maybe it's a good time to reconnect because we also do have a growth fund. So I'm thinking a lot more about proximity and building relationships around the things I've always said I care about, but in a really much more deliberate way versus, 2 months ago, I was on a plane to the Bay Area every other week. I still feel very strongly about the Bay Area. I sit on 4 boards in the Bay Area, but, I'd say that thinking about Southern California, LA, and how to build relationships here much earlier around people who we could be funding 6 or 12 months from now. That's, definitely a thing I'm taking a lot more time to do right now. And then I'm also just trying to be deliberate about the areas of proactive focus, and so those are Southern California areas, and that's broad, but for me, that's been a lot around workforce training, education, security, software, infrastructure. And so trying to be slower and more deliberate about how to spend more time with fewer people in those areas.
And I think Kara, just to build on what Kara said with 2 sentences, I think she hit the nail on the head that, I always think it's about making sure the entrepreneur fits kind of your firm, but vice versa, right? And so again, and just to kind of push the thinking and to build on that. So an entrepreneur said, but I've never even met you. I said, hey, well, let's take a walk and talk. He said, well, how can we do that? I said, well, you have a phone, right? He said, yeah. I said, do you live on a street? He said, yep. I said, all right, let's go do our walk and talk, right? And again, was it the same as a walk and talk? No. Was it better than sitting in a chair? I got an Aura ring yesterday. It turns out I was inactive for 9 hours and 21 minutes. That's pretty depressing for all of us, right? At least I have to walk back and forth in the office or to the conference room. But it was amazing, right? We had a different interaction because we did an hour walk and talk with our cell phones walking down a tree-lined street. And again, it's those little things that, was it as good? No. Was it better than a Zoom? Yes. And so again, there are ways, and I think it's important for entrepreneurs that we're funding or upfront funding to also feel comfortable with us, right? Because it is a two-way street, because we are in this together. We are going to be in the trenches in the good days and the bad days. And I promise you, there will be both days, right? And so you really need someone that you can kind of be arm in arm with.
We're going to talk about changing consumer behavior in just a minute, but I want to ask about changing VC behavior, because we've all gotten so much more used to doing things by Zoom and meetings. And our founder, Spencer Raskoff, was saying the other day, he doesn't think he's going to be doing as many as those, red eyes to New York for a board meeting or a pitch. So how much of this do you think will be permanent and will be done via Zoom even when this is all over?
Yeah, I'll start and then Carrie, you could jump in, but I think it will be, the new norm will be a new norm and it will be phased. And so I think the one thing is we all have short memories. And so at some point we'll forget this happened or it will be a memory, but I don't think that point is coming anytime soon. I think what's more exciting is it's already accelerated adaptation curves that were already happening, right? So we have 3 partners that came from a company called DigitalOcean. Voted one of the best places to work in the US last year, and it's 75% remote, right? And so we were very set up for remote. It's kind of part of our culture. I remember when those 3 partners started, they said, we're not going to do phone calls anymore. We're going to mostly do video. And I'd be running to the airport, trying to get that red eye to New York or that flight to the Bay Area. and they'd be videoing me, and I'd say, oh, come on, like just make it a phone call. I'm trying to get through security. But it was those little things that kind of ingrained it in the culture. Obviously, we've never had an event that's kind of made things that behavioral changes have become so fast. I was emailing someone at Goldman Sachs, and they used to not be able to open up DocSend links, right? For the last 5 years, Goldman Sachs could not open DocSend links. Well, necessity is the mother of all innovation. They can now open DocSend links. So anyone who wants to send a deck to Goldman Sachs, you can now send it on DocSend instead of PDF. And so I do think you'll see a lot of these changes being more permanent. And the changes when you want to go see someone in person, again, the bar will also be higher, right? Because why would you fly if you can do it just as well on Zoom? You still will. But again, I think we're all going to be a little more selfish with our time and with our health and with the health of others. And as a result, the bar is going to be higher for any behavior that was kind of typical of the past, potentially.
And Kara, are you going to spend less time on planes after this is all over, do you think?
I think I probably will. I mean, again, I think one of the really interesting things now is if you're fortunate enough to have the opportunity to appreciate silver linings, there are lots of silver linings, and for sure, the silver lining for anyone who has kids in the house is seeing them. I've had dinner every night with my kids for the last 5 weeks, and I've never done that in my life, and that's been amazing. And so I think there's a lot, obviously things like the whole idea of FOMO, or I mean, there's new kinds of FOMO. It's just now, because you're not invited to Clubhouse, you're not invited to, a big event in a fancy place. But I think this idea of like what's important, where do you spend your time, is gonna change. And I think we'll still get on airplanes, but we'll be a lot more thoughtful about it. I think, for example, one of the things I've thought about is I think you'll have a lot more just board meetings maybe that are happening over Zoom. It was interesting. I was looking at a fully remote company, maybe 5 months before this happened. And one of the things that was appealing were all kind of Zoom board meetings, because I find that the most impact that I have on founders and vice versa are the in-between meetings. And I do think it's really important to spend time in person, but the spending time one-on-one, spending time meeting with the head of sales, et cetera, those end up having kind of more impact often than a bunch of performative stuff in a boardroom. And so I think we're going to test our norms around how much we need to travel, what we're doing when we're doing it, how many events are truly mission critical, trade shows. I mean, a lot of different things in that nature. So my hope is I'll be a little bit less on planes, but my hope is I'll also still be on planes, because I miss getting on airplanes a bit as well, I have to say.
What's wrong with you? You miss getting on airplanes. Wow.
Ben, should I ask her, or are you going to ask her the question we've all been waiting for
Yes.
this whole hour about the Upfront summit and whether
Yes.
I have something to look forward to next year,
I was wondering that.
I think we have Carrie Bennett, who runs marketing in the event for us, somewhere out there in the participant list. Carrie, do you want to type something into chat so everyone can see? I don't know what our public message is, but we view the Upfront Summit as a permanent endeavor and an important element to the community. And I appreciate your guys' energy and enthusiasm for it. But I don't know
think
that
everyone just let a sigh of relief out there that's the case.
There we go. We got Carrie Bennett. She came through. She said, stay tuned on the Upfront Summit. So you heard it here first.
Okay, well, we will keep our fingers crossed. We would certainly love for that to happen for many reasons. But I want to get a little bit to the meat of what you're looking at in your investments right now. And Carter, as someone who looks at consumer behavior and how consumer behavior is changing over the next decade, I'm really curious, what you're seeing in terms of how this will permanently change behavior, and what is temporary and what is not.
Yeah, I think when we think about kind of like everyone, there's just too many unknowns, and none of us are smart enough to know kind of what the future holds. And so I think the best thing we can do is all put together frameworks to try to think about how the future could unfold. So we're trying to think about kind of short, medium, and long-term changes in consumer behavior. Obviously, we want to invest between medium and long-term changes and avoid the short-term changes kind of being reactionary. I think then when you look at the other kind of vertical kind of access, we're using a few filters. One is this is obviously accelerated adaptation curves, right? So things like meal delivery, cloud kitchens, online shopping, these things were already happening. They were already happening for certain demographics. They've been accelerated for those demographics, and other demographics kind of accelerated even faster. Then I think there's what we call a filter that I think is the most interesting that we're spending a lot of time on looking to invest is what I call the eye-opening kind of filter, right? Which is, oh my gosh, I never knew how easy it was to do calls on Zoom, right? To work from home. I never knew how easy it was to have my children tutored online or things like that. And so these were things that entrepreneurs were trying to tackle, but quite honestly, the adaptation curve wasn't there. Therefore, the total addressable market wasn't there. I think you're going to have a lot of behaviors where people realize, wow, I can kind of do this, and this is a really interesting opportunity. So I think we're most obsessed with thinking about what are those behaviors where someone's going to have an aha moment. And as a culture, we said, there's something there. And then I think it is, I think it's naive to think that the health and safety and behaviors on the margin won't change, right? Again, and so I think it's really, for us, the nuances and the insights are second and third kind of ripple effects. The first ones are unknown or obvious. It's the second and the third. And so I think you'll have, you have the collision of a recessionary environment, most likely, with a COVID-19 event-driven kind of around health. We've never had those things come together. And so thinking through how different consumers are going to react differently and in different categories. So to give you an example, and then I'll pause, is I'm going to go back to hotels. But sometimes I stay at fancy hotels. And sometimes when I'm by the airport, I stay in a hotel that costs $89 a night because, to be honest, all I'm doing is going to bed, waking up, and getting on a flight. I might be willing to pay a premium for that nicer hotel because I'm going to trust more in the safety of that hotel and the disinfectant and things like that. And I might not be willing to go back to that $89.99 hotel, right? And so that's a change that's both short term, but probably will be medium and potentially even longer term. And I'm willing to put a premium on health and safety in that context, right? And so I think for us, we're trying to break down the changes in consumer behavior by industry, by demographics, and then really think nuanced about it. And one of the things we always talk about is for entrepreneurs, we wrote about it in our book, Shortcut Your Startup. It was this idea you need a telescope in one eye and a microscope in the other eye. So this idea that you have to be outward facing and strategic at all times, but at the same time, downward looking and kind of focused on the day-to-day. I think whether you're an investor or an entrepreneur, that holds more true today than ever. That and again, it will change. I'm sure Kara and I, the way we're thinking today is probably different than last month, or I can guarantee you it's different than last month. And it will be different in 6 weeks or 8 weeks or 12 weeks because, there's so many unknowns.
And Kara, what are you, thinking of in terms of changes to consumer behavior, and what sorts of companies are you interested in now that you maybe weren't as interested in 2 months ago, and what kind of companies are you avoiding now that maybe you were really interested in a couple of months ago?
Yeah, so let me try to unpack this. So first of all, I think when you take money from an M13 or an Upfront and you're in a particular sector, Carter and his team have great relationships across retail and brand and and distribution, and so you're kind of taking their network and their sensibilities but what I think the flip side is, and the same thing, for Upfront, we have different people who focus in different areas. And so we all have some set of themes or theses. We have people who focus on healthcare. We have people who focus on gaming. We have people who focus on ag tech and sustainability. We have people who focus on consumer and marketplace. We have people that focus on enterprise software. And we all have theses, and you would take away my venture capital card if I didn't. I would go back to home base and have to start over. But I think my personal belief is that we use them to find exceptional founders and people who are going to navigate trends in a much deeper way than we can forecast and predict. And some of the best businesses we've invested in on the consumer side started as something different. You know, you take Goat, which is, you know, the sneakerhead marketplace here in LA, and we were the first investors in. It was led by my partner, Greg Bettinelli, and it started out as a restaurant booking app. It was then something else. And, you know, those things weren't working, and they sort of true pivoted into something completely different. And so I'm going to answer your question, but I think more broadly speaking, it's a lot of why it's important to think about changes in behavior patterns, trends, what we want to fund are so we can put out into the world why you should come talk to us. And then we have relevant knowledge and experience to be valuable to you in your journey. But because we come in so early, a lot of what's valuable in your journey is being a good human being who does what we say we're going to do. And a good human being doesn't mean funding all the time, but it means giving you feedback early. It means taking the time to really think about your business and help, you know, recruit and land people and telling you when your burn is too high and just being a productive partner. So it's a little bit of a precursor to say, I'll tell you what I think in terms of predictions and what we're looking at, but I'm sure that I'm at least half wrong. And we're trying to back the founders who will figure it out. I think the first thing is the biggest and most interesting insights I think are going to come from existing businesses who like are in the food category. And we have a company called Territory Foods, for example, and they were serving, they create meal packs, ready to eat meal packs for people who are fitness oriented and live by a food tribe. So Whole30 or plant-based, et cetera, but they distributed really heavily through gyms. They had a refrigerator in gyms and you picked up on through gyms. So that business went to zero, right? Overnight, they moved to delivery. Now they're testing grocery boxes and essentially like chef oriented fresh produce boxes where you have spices and recipes, but they're testing a bunch of different things because they just have a different food supply chain. They work with restaurants that are closed, like Cafe Gratitude in LA. Cafe Gratitude kept one location open to serve all their customers and shut everything else down, but they're serving customers through Territory now. And so I think, I have another company that I invested in here called Skylar, which was, kind of a clean fragrance company. They've launched hand sanitizer, and it would typically take 6 months, but they're doing scented, clean hand sanitizer. They're launching end of this month. And these companies are existing companies that already have a foot in the market. Carter mentioned Daily Harvest, where they're just seeing really different behaviors, and it may be, bigger behavior, like more purchasing of what they already do, which we're seeing for companies probably like Daily Harvest and, Parachute Home as an example in our portfolio. But then you're seeing others who are seeing these little pockets of new demand, who are out there testing things quickly and moving into it. I think Carter mentioned this, and I agree with him 100%. There are some new trends that will pop up, but for the most part, a lot of what's happening is an acceleration of what was already going to happen, right? So I spend a lot of time looking at security and education. In education, kind of understanding that a lot of universities would probably go out of business, or a lot of people were being saddled with student debt but not graduating and not developing skills that they could bring into the workforce, was something we already knew would happen. It's painful to think about a lot of universities going out of business, and many of them shouldn't, but there may be new ones that pop up that are teaching you in a new way, in a lower cost way, where employers are paying for it or bringing it into the workforce in a way where we may be sort of accelerating a trend that was already in place. Similar on the work from home side, I'm in a couple security companies, one called OpenRaven here in LA and one called Fleetsmith up in the Bay Area. And they, the trends that they're seeing are sort of like the priorities for the C-suite of enterprise companies are now secure work from home. So if you're a Goldman Sachs, you can click on a DocSend link, right? And that was the only priority in the first few weeks, but now you're moving to risk assessment. How do I know where my risk is, where people are working in a completely different way? The other thing that's interesting is you're seeing digital transformation strategies start to take precedent. Like you have certain companies like car companies and airline companies and travel companies. Once they've figured out how to kind of stay in business and conserve cash, this is a great time to shift, to go to do their digital transformation, to figure out how to move into electric, or to figure out, how to move from on-premises into the cloud. And so there will be an acceleration of the things that were kind of more fundamental things that were being put off because you had to hit a certain PE ratio to keep trading in the same way. And so what those things are, I don't know, but there should be some really interesting innovation and opportunities there coming from traditional industry.
But even before this, I talked to a lot of VCs who said they wouldn't touch DTC companies, mainly because the marketing and customer acquisition costs have gotten too high and that Amazon was just too powerful. So what do you think happens to DTC companies now?
I mean, I think Carter and I could probably talk for a couple hours each on this topic. So I'll try to start short and hand it over. Maybe we can make it punchier. But I think you're going to see true category leaders emerge right now with companies that understand how to do D2C. Everything we're buying right now, we're buying online. And so, there are certain categories that haven't moved online as quickly, for example, home. But you're seeing certain companies in home doing incredibly well right now. We have one in our portfolio called Parachute. But I think if you can connect with a consumer online and you are running strong fundamentals in your business, so make money on the first purchase, get customers coming back, getting them purchasing more frequently than they a change in behavior that you're seeing happen through your products. The retail world will come back. It will come back in a different way. And I think it's sort of giving the companies who started, I'd say, digital first, maybe an opportunity to focus on that piece while they're very thoughtful about how to go back into the world. So maybe you don't go back into as many locations, or you're not going back into malls. But I mean, here in LA, you can walk the streets in a lot of expensive neighborhoods, and you've been seeing vacant signs for 6 to 12 months, and there needed to be some sort of rebalancing between rent, how people purchase, when they purchase online, when they purchase offline. All that's still going to happen, and your ability to connect with consumers digitally is even more important. The ones who can do it, I think, will come out of this stronger if they can figure out how to survive. And so cash and profitability has been, I think, the siren in consumer for probably the last 9 months. Consumer readjusted pretty, I think, earlier, coming out of WeWork and others. And again, now you're seeing certain areas being hit much more. And so those are harder areas to predict, but there are other areas where, digital first could be a real advantage.
What do you think about, Carter, what's your pitch for DTC companies, and which ones do you see making it, and which ones do you worry about?
Yeah, I mean, I think the carrot touched on most of it, so I'll keep it short, but I think it all comes down to discipline, right? And I think a lot of D2C companies were built probably with a lack of discipline over the last few years because capital was readily abundant. And then quite honestly, the economics of that change with some of the cost of CPAs and things like that getting more expensive. I think what we're looking forward, we've been talking about this kind of rise of the micro brand for a while now, which is we think you're going to have fewer large D2C companies, but you're going to have more smaller, and again, small can be a few $100 million in sales. D2C brands. And so I think what we look for is kind of what we call extreme product market fit. Take a brand like Daily Harvest. They've obviously had an exceptional growth and kind of profitability, and built the company very well because they have a product that a certain set of consumers cannot live without. And when people talk about LTV and AOV and CAC, all you're talking about is really, it's not a math equation. It's, do people love your product, and do people need your product, and will it become habitual forming, right? And so I think that's really what it comes down to. And so I think you'll have a bunch of it. And I think what's exciting is, one of the things that entrepreneurs struggled with the last few years was the growth expectations put on these businesses because of kind of the bar was there, right? Clearly businesses aren't going to grow quite at the same pace they did the last few years as the future years in the forward. And so hopefully that allows entrepreneurs a more solid footing to build a strong foundation and a more, more profitable business, or a business that makes more sense from a P&L perspective.
And what about valuations? I mean, it seems like this puts you guys a little bit more in the driver's seat, whereas founders have had a lot of the power in recent years and been able to shop around a lot. We've seen the public markets come down a lot, which hasn't necessarily been reflected, at least publicly yet, in the private markets. So I'm wondering, what you're seeing in terms of valuations and how it differs at different life cycles of a company.
I see Kara's wheels spinning, so I'm going to let her take that first, and then I'll follow up.
So I think, good partners will try to be good partners on valuations. I think what you're seeing right now is it's seed and kind of early A. Valuations haven't changed that much, but again, there's a lot more discipline around it. We've heard from a lot of our peers up in Silicon Valley who invest at the seed stage that the seed deal is back to 2 on 5, right? So the 3 on 7 kind of, or the uncapped notes and these sorts of things are changing. But I think if you went to many of the firms that are kind of often who are talked about as firms you might want to take money from, there was always some level of discipline, but everybody kind of creeped up. But at the early stage, I think it's somewhat similar, more discipline and probably a bit more ownership for the company. I had a number of companies that were in market at every stage, from kind of series, seed and series A, all the way to, later stage growth. And I think a lot of what we're seeing is trying to price things. If you need money right now in a note structure, because it is hard to know exactly where to price things in a note structure, that if the founder and the company were performing well, or set them up to perform well. We all want everyone to perform well. I think it also is making sort of, the recaps and changing things around and really making sure you have long-term capital partners in your cap table easier to digest. One of the things I saw and I felt when I was a founder is when you go through those moments, and almost everybody does, it's like the exception if you don't. And we've lived in a market where it doesn't seem like you go through those moments, but startups are hard and, the people who do them and continue to do them are exceptionally resilient and optimistic. And, it's why we're lucky to do this job. But there was a lot of shame around kind of the resets on valuations. And now I think that's gone. And it's actually, I've seen it in a strange way be liberating for certain founders who realize this is what they want to do. They have people who want to support them. Maybe not everybody. And, you're definitely seeing weird behavior across syndicates now. And, kind of not everyone doing what you would hope they would do in these times, but you're also seeing admirable behavior across people and funds going to bat for things. So I'd say it's shaking out. There are parts of the market where it's shaking out slower. Later stage enterprise hasn't really changed yet, but everybody, I did a call with a bunch of investors across stages last week, and everyone said everyone expects it to change, but it's just going to take a lot longer to move through the system. Whereas like early stage and series A, B consumer probably changed 9 months ago, right? Or 6 months ago. So it's different across the board. And a lot of it has to do with, do you need cash now? Do you have, 24 months of runway is kind of like the gold standard. If not, how do you get there? And do you have partners on the inside who have reserved for you and can help you work through it?
And what about you, just briefly, Carter? Are you dropping the hammer on valuations? Are you, ripping up term sheets you may have signed 3 months ago and dropping it by half?
Definitely not doing that. I mean, I think, like Kara said, it's unrealistic to think that there won't be downward pressure on valuations, right? If you look at where the average Series A was in 2010, it was around just north of 10 million, and today it's around 30 million. So there's a lot of space there. And again, it wasn't that long ago. And again, some of the letters of these rounds are fungible. I think the way I get excited about it, and I think entrepreneurs should think about it, is I always remind our team internally, as well as entrepreneurs, that we invest in great companies and good deals, right? Because investors, we're trying to generate risk-adjusted returns. And so we're trying to make a calculation based on what we perceive the risk to be and what the potential upside is. And so when valuations are really high, right, there was a lot of great entrepreneurs and a lot of great companies we weren't able to invest behind because there was just a lot of risk to take for the potential kind of exit scenarios. And so I think it can be liberating, right? I think we have lived in a world the last few years where artificially high valuation was nothing more than a vanity mark. And it might feel really good in the moment when your name, appears on the pages of dot.LA in that article, but that puts a lot of pressure on the business, right? And it puts a lot of pressure on the business to continue to grow at sometimes paces that are artificial. And so I think it can be a net positive. I know I'm excited to hopefully get the opportunity to invest in a lot of companies that will have hopefully just more realistic expectations. And I think it will kind of be a sigh of relief for entrepreneurs that they can build great businesses, but they don't have to be chasing a valuation of their next round. They don't have to be chasing a growth rate, but right. Whereas growth at all costs was really cool the last few years, the coolest thing moving forward is going to be controlled growth with profitability, right? That will be the new cool kid kind of thing.
Well, we are almost out of time, but I want to end with both of you with something that's very important to our mission at dot.LA, and I know is important to you guys, which is what is specific about this moment to LA, and how potentially is LA special in this moment. And Carter, you're from Chicago, so you're watching a lot of The Last Dance. Kara is an LA native, but you've been here a long time. So let's start with you, Carter, about thoughts about LA specifically.
Yeah, I think, look, we chose to start Up 13 in LA because we think we're obviously part of, like Upfront, the long LA movement. And we think, right, when we talk about consumer tech, we talk about so many businesses now have a direct relationship with an end consumer. So even an enterprise, something like Slack is B2B2C. And so we think, LA is, we thought it was before it was the case, and we still think it is today, which is LA understands consumers almost better than everyone, right? They understand brand, they understand media, they understand influence, and they understand all these things. And I think Kara said it best earlier, which is, we invest a lot around mental wellness in these areas. Anyone who's already been investing in these areas will be, whether it's as investors or entrepreneurs, will be able to figure out where the next waves of these technologies or business models will come. And I think never have we lived in a time where it's more important to understand how consumer behavior is going to change, because whether you invest or build companies in enterprise or consumer, we're going to work differently. We're going to travel differently. We're going to interact differently, and we're going to act as human beings differently. And obviously you can tell, I think LA is uniquely positioned both from the investor side and the entrepreneur side to be one step ahead of the rest of the world when it comes to understanding kind of the changes in human behavior.
Kara, your thoughts on LA?
Yeah, I definitely want to end with a lot of optimism for LA. I can start with Carter. We think so highly of Carter and Courtney and the M13 group, and having big funds like that in LA, in addition to Upfront. I mean, it just didn't exist 5 years ago, right? And so you need the founders, you need the capital, you need the sectors. And if you just look at LA in general, and sort of our diversity across, large, one of the largest healthcare systems, like top material science program out of UCSB. We have a company that came out of that called Appeal. You've got JPL and SpaceX on the space side. You've got huge kind of like food consumption. You have in one of the biggest counties and most diverse counties in terms of small business. I mean, we're a microcosm of the country, and it is an incredible time to start. It will be an incredible time to start a business where you don't have to chase growth for growth's sake, and you can go after real problems and live in the middle of those problems and opportunities at a moment in time where, one of the positive things that you feel now that you felt a little bit at some of the other crises, but so much more deeply and globally now, is the sense of duty, right? And the sense of, I want to do something meaningful with a life. And I think here in LA, we're more interdisciplinary with the kind of real tech and product talent, with the kinds of funds that the next generation of companies that could change the world will be funded in the next couple of years. And I have every reason to believe they're going to come out of LA.
Well, thank you so much, Kara and Carter, both of you. We really appreciate you sharing your insights, and this has been really interesting, and we'll continue to check in with you and see how you guys are doing, and really appreciate you joining us. I also want to thank all of you, our audience, for joining us, and remind you to sign up for our .LA newsletter. It comes out every afternoon. Today, I have a story about Wonder Ventures launching a new fund to reach out to people remotely to fund out unemployed people with ideas who may have the next great LA company. My colleague Tammy also has a story about LA companies taking advantage of drones during this time. So please sign up, and please join us next Tuesday as well for our next webinar.
Thanks so much, Ben. Appreciate it. And thanks to .LA.
Thanks, Ben. .LA, Spencer, Sam, all of you guys, appreciate it.
Thanks.
Bye, everybody.
Thanks a lot.